Imagine two investors. The first investor spends hours studying companies. He reads financial statements, watches market news, analyzes balance sheets, and tries to predict which company will grow in the future. The second investor does something very different. Instead of choosing individual stocks, she simply invests in a mutual fund managed by professionals. Both investors want the same thing, long-term wealth, but their paths are completely different. This brings us to an important question in investing. Should you pick individual stocks, or should you invest through mutual funds? To answer this, we first need to understand what direct equity investing really means. When you invest in direct equity, you are buying shares of individual companies. For example, if you buy shares of companies like Apple Incorporated, Amazon, or Tesla, you become a partial owner of that company. Your returns depend entirely on how well that company performs in the future. If the company grows, expands, and becomes more profitable, the value of your shares may increase significantly. But if the company struggles, your investment could decline. Direct equity offers something very powerful: control. You decide where your money goes. You decide which industries to invest in, and you decide when to buy or sell. For investors who enjoy research and analysis, this can be exciting. Some legendary investors built their fortunes this way. One of the most famous examples is Warren Buffett. Buffett carefully studied companies and invested in businesses he believed would grow for decades. His success turned him into one of the richest investors in history. However, direct equity investing also comes with challenges. Picking the right company is not easy. Financial statements can be complex. Markets move quickly, and even great companies can experience unexpected setbacks. Many individual investors make decisions based on emotions, fear during market crashes, and excitement during market booms. These emotional decisions often lead to poor investment outcomes. This is where mutual funds enter the picture. A mutual fund collects money from thousands of investors and invests that money into a diversified portfolio of assets. These investments are managed by professional fund managers. Instead of choosing individual companies yourself, you rely on experts who analyze markets and make investment decisions on your behalf. One of the biggest advantages of mutual funds is diversification. Imagine investing in just one company. If that company fails, your entire investment could suffer. But if your money is spread across dozens or even hundreds of companies, the risk becomes much smaller. Mutual funds provide this diversification automatically. Another advantage is professional management. Fund managers and analysts study markets full-time. They track economic trends, company earnings, and global events that might affect investments. For many investors, this expertise can be valuable. However, mutual funds also come with certain drawbacks. One of them is management fees. Since professionals are managing the investments, investors must pay a small percentage of their money each year as fees. These fees might seem small, but over long periods they can reduce total returns. Another limitation is lack of control. When you invest in a mutual fund, you cannot decide which companies a fund manager buys or sells. You simply trust the strategy of the fund. Some investors are comfortable with this. Others prefer having direct control over their investments. There is also the question of performance. Many studies have shown that a large number of actively managed mutual funds struggle to outperform the broader market over long periods. This has led to the growing popularity of passive investment strategies, such as index funds. These funds simply track a market index instead of try to beat it. But despite these debates, both approaches can play a role in building wealth. Direct equity investing may appeal to people who enjoy research, analysis, and long-term company valuation. Mutual funds may appeal to those who prefer simplicity, diversification, and professional management. Some investors even combine both approaches. They might invest most of their money in mutual funds for stability, while using a smaller portion to pick individual stocks. This strategy allows them to benefit from diversification, while still participating in the excitement of stock selection. Ultimately, the choice between direct equity and mutual funds depends on several factors: your knowledge of financial markets, the time you are willing to spend researching companies, your tolerance for risk, and your overall investment goals. Investing is not only about numbers. It is also about psychology. Some investors feel confident making their own decisions. Others prefer the reassurance of professional management. Both approaches can succeed if used with discipline and patience. The key lesson is this: there is no single perfect way to invest, but there is a perfect strategy for each individual investor. Understanding your strengths, limitations, and goals is far more important than following the crowd. And in the world of investing, the best strategy is often the one you can stick with for the long term.